Every civilization in human history has been built on land. Before currencies, before corporations, before financial markets and digital money, there was property. Land meant food, shelter meant survival, ownership meant power. Those who controlled land controlled people, resources, and the future. For thousands of years, land was stability. It was passed down through generations, not traded in seconds. Wealth was measured in harvests, not speculation. But modern finance transformed something ancient into something volatile. Real estate stopped being a place to live. It became a promise that prices would rise, a promise that wealth could be created without productivity, a promise that risk could be ignored. Homes became investments, neighborhoods became portfolios, cities became financial products. Banks quickly realized something fundamental about human psychology. People will sacrifice almost anything to protect their homes. They will work longer hours, accept lower quality of life, and take on crushing debt rather than face the fear of losing shelter. That emotional attachment made real estate the most powerful financial anchor ever created. And anchors invite leverage. As property prices rose, confidence followed. Rising prices made people feel richer, even when their income stayed the same. That illusion of wealth unlocked borrowing. Equity was extracted from homes that had not truly been paid for. Investors borrowed to buy multiple properties. Developers borrowed to build faster, higher, and riskier. Governments encouraged it. Home ownership was framed as success, stability, and patriotism. Banks loosened lending standards. Media celebrated rising markets as proof of economic health, and everyone repeated the same sentence. This time is different, but real estate does not grow because societies become more productive. It grows because belief expands, belief that prices will keep rising, belief that demand will never end, belief that debt can always be rolled forward. Belief is powerful, but fragile. History has warned us repeatedly. In the 1920s, American cities expanded rapidly on borrowed money. When housing prices stopped rising, defaults spread quietly. Banks collapsed, businesses failed, the Great Depression followed. In post-war Japan, land became so valuable that a single block in Tokyo was said to be worth more than entire American states. When that belief collapsed, Japan entered decades of stagnation that it never fully escaped. In the early 2000s, homes were sold to borrowers who could never afford them, justified by the idea that rising prices would solve everything. When prices stalled, the global financial system nearly broke. Each time, the beginning looked harmless, even optimistic, because real estate bubbles do not explode loudly. They grow silently. They feel solid, stable, responsible. They promise security, not speculation. But beneath the surface, pressure builds. Debt stacks higher. Risk concentrates in places no one wants to examine. And when the foundation finally cracks, the collapse feels sudden, even though it was decades in the making. To understand why every financial crash begins with real estate, we must understand debt, not as money but as obligation delayed into the future. Real estate itself is not destructive. Debt is what turns it into a systemic threat. Banks do not simply lend existing money. When a mortgage is issued, new money is created. That new money enters the economy instantly, pushing prices upward. Rising prices then justify larger loans, which create more money. The cycle feeds itself. As long as prices rise, the system appears safe. But safety here is an illusion. It depends entirely on continuation. Over time, banks stopped holding mortgages on their own balance sheets. Loans were bundled together, sliced into financial products, and sold to investors across the globe. A single-family home could influence pension funds, insurance companies, hedge funds, and even governments. Risk did not disappear. It became invisible. Rating agencies labeled complex products as safe. Investors trusted models instead of reality. Regulators trusted institutions instead of questioning incentives. Everyone assumed someone else was managing the danger. Meanwhile, borrowers became dependent on refinancing. Rising prices allowed debt to roll forward endlessly. Interest rates stayed low, hiding stress. But debt has a weakness. It demands payment in the real world. When interest rates rise, when wages stagnate, when job markets weaken, the pressure reveals itself. Defaults never begin dramatically. They start quietly. One missed payment, then another. Refinancing slows. Property prices stop rising. Suddenly, collateral is not enough. Banks respond by tightening credit. Liquidity disappears. Businesses cannot borrow. Consumers stop spending. Layoffs begin. Stock markets react violently, but they are not the cause. They are the echo. Real estate sits at the center of modern economies. It anchors household wealth, bank solvency, government tax revenue, and long-term savings. When property values fall, the damage spreads everywhere at once. In 2008, trillions were destroyed not because homes vanished, but because trust collapsed. Trust in prices, trust in financial models, trust in institutions designed to manage risk. Once trust breaks, fear spreads faster than money ever did. Governments intervene. Banks are rescued, systems are patched, but the consequences remain. Years of growth vanish, inequality deepens, faith in stability erodes. Real estate turns local mistakes into global crises because debt connects everyone to the same foundation. And when belief collapses, numbers lose their power. Today, the warning signs are once again visible. Housing prices have risen far faster than income. Debt levels are higher than at any point in human history. Commercial real estate stands partially empty while loans remain fully leveraged. Refinancing has become harder. Margins thinner. The system insists it is stronger now, better regulated, more sophisticated. It always does. Technology has accelerated finance, not stabilized it. Capital moves instantly. Risk spreads globally in seconds. What once took years now takes weeks. When real estate weakens, governments lose tax revenue. Banks lose collateral. Pension funds lose stability. Ordinary people lose savings and security. The next correction will not announce itself. It never does. It will begin with slower sales, rising defaults, tighter lending. Then confidence will fade. And when confidence fades, the cycle accelerates. History does not repeat because people forget facts. It repeats because people ignore patterns. Every generation believes it has outgrown the mistakes of the past. Every cycle proves otherwise. Real estate remains the foundation of the financial world. And when foundations crack, everything built upon them shakes. The next crash will not feel new. It will feel familiar, because every financial collapse still begins the same way, with land, debt, and belief colliding. And when belief fails, reality always wins.